Welcome, everybody, to Martinis with Scott, a show about winning momentum in life and in business. Thank you for joining me on a Thursday afternoon, 4 p.m. Eastern. We are releasing this. Hope you're joining me for a drink. Cheers. I am drinking the Lagavulin 8 today, a nice, beautiful scotch from Lagavulin. I've been pitching and negotiating and just generally talking pretty much 14 hours a day for 3 days straight, and my voice is getting a little scratchy, so I'm hoping I'm going to make it through this, and I thought a little glass of scotch rather than a martini today would help me. What are we talking about today? By popular request, I've had many people reach out to me and say, hey Scott, what is your take on this whole GameStop thing? This is not really about how to change your life and how to gain momentum in your business. But it's definitely a fun story, and it's finance related, and maybe I do have a different take. So let's take a shot at it. This is what we're going to talk about today. So look at, my view is that this is a very fun story. I've enjoyed it a lot. I have not spent a ton of time digging into it, but I've enjoyed the story. I didn't know this before. It turns out there's very little that I enjoy more in life than watching billionaires freak out on CNBC and yell at the little people and blaming the stimulus checks of the $1,400 or $2,000 in 2020 into the unemployed's hand and how it's being used to cause them billions of dollars of losses. That's pretty funny stuff, near as I can tell. But, this whole GameStop story would not be interesting. It would not be interesting if it didn't have the underlay or the overlay, whatever that is, of a global theme of populism intersecting with the modern power of social media. So what do I mean by that? Well, the social media part's obvious, but the populism part, I always laugh at I always get confused by the people on CNN and the left-wing press in particular, even the right-wing press, even on Fox in the US, when they're talking about populism as if it's a bad thing, whereas the populism is a politician who's striving to appeal to the quote unquote ordinary people who feel that their concerns are disregarded by the established elite groups, right? It's the ordinary person feeling that they've been left behind, that the wealth gap is growing, and that the elite don't care about them. And isn't that exactly what Trump's pitch was? Isn't that how he got elected? Is rightly or wrongly, you don't have to love him or like him or hate him or whatever, but rightly or wrongly, he was perceived as the one that would stand up and fight against the establishment for the ordinary people. It's a trend, not just in the US, it's a trend everywhere right now, except for Canada, apparently. We're all good with the elites ruling us as we sit here. And then we come to the 2020 election in the U.S. So we got Biden versus Trump, and Biden represents the rich, powerful, and elite, and the elite win, and that's the end of that. Populism lost. How does that relate to this story? There's a lot of resentment. There's a lot of anger in the ordinary people. There's a lot of need in the media to create this narrative of the ordinary people versus the elite, of the establishment fighting back against the rogue element. That would be the reverse side of this. And if you didn't have that, this story would still be funny, but it wouldn't gain such national and international attention. All it would be was a bunch of billionaires screaming and yelling on CNBC, which is still really, really, really funny, near as I can tell. Okay, what is GameStop? We'll just go through some background on this. For those of you who don't follow the story, you live a normal life, and you don't really care about these billionaires. God bless you. That's helping my throat, that scotch. GameStop Corp operates a multi-channel video game, consumer electronics, and collectibles retailer in the United States, Canada, Australia, and Europe. Think Blockbuster. Do you think these guys have a long-term business plan? Company sells new and pre-owned video game platforms. It's not only Blockbuster, but it's a rent. You can turn in your old platform to these people. Accessories including controllers, gaming headsets, virtual reality products, memory cards, so on and so forth. In-game digital currencies, downloaded content. So it sells collectibles, compromised licensed merchandise, primarily related to the video game. Operates stores and e-commerce sites under the brands GameStop, EB Games, Micromania, Zing Pop Culture, Think Geek brand, as well as the Game Informer. As of February 1, 2020, the company operated 5,509 stores across 14 countries. Founded in 1996 in Grapevine, Texas. Beautiful downtown Grapevine, Texas. If I just jump to my capital IQ here, it would tell me that revenue of GameStop for the trailing 12 months would be $5.2 billion. It's a big company. And on $5.2 billion, they managed to lose $130 million at the EBITDA level, not even at the net income level. They lost $275 million at the net income level. How do you lose money on $5 billion? That's just, that's bad management. Market capitalization, well, we won't talk about that because that'll be skewed by the stock price. So you've got a big retailer who does video games and related stuff. It's got a bunch of locations in 14 different companies, $5 billion in revenue and losing money. Maybe that's COVID influenced. It is a trailing 12 months. So maybe I'll give the management team the benefit of the doubt on that one. All right. So GameStop trades on the New York Stock Exchange. A little bit of background. Because we have a podcast version, I won't show you a chart. I was going to print out a chart and hold it up to the screen here for you on YouTube. But let's just walk through it. So 2018, 2019, let's call that calendar year and fiscal years. The stock was in the range, well, I don't know what their fiscal year is, doesn't matter. So call it calendar years. 2018, 2019, the stock just kind of bounced around flat in the range of $14 to $15. Listen, I have not spent a ton of time analyzing this. I haven't read any research reports. So if there's anomalies in what I'm saying, it's close enough for the point of my story. $14 to $15 for a couple of years. And then by January 2020, so in the fall of 19, it starts dropping. And by January 2020, it was down to $5 to $4, bouncing around in that range. Now, what happened for the $14 to $15 for a long, long time? How did that drive down to $4 to $5 in January 2020, started in the fall of 2019? Well, the answer is probable, without having pulled the positions, short sellers. And we're going to talk about what short sellers are here shortly. Stayed around in 2020 until at the $4 or $5 range, fell down to $3 to $4 in the fall of 2020. And then around September, started increasing. Why did it start increasing? So we're going to talk about short sellers driving the price down and how that works. And then you had the longs, which are people that, let's call them value buyers, value buyers or speculators, or somebody who wants to own the stock because they think at $3 to $4 is underpriced. Maybe it's been hit by COVID. Maybe you think COVID's ending soon. Whatever the answer is, they start buying it. And by the end of 2020, it's gone up. I think it was actually December 31. It's gone up to $19. So you have a long history of $14, $15. You got a decline down to $4 to $5, $3 to $4, and then a sort of a September, October, November, December of 2020 climbs back up past the 14, 15 where it used to be, and it's at 19. Not an interesting story. Happens on stocks all the time. Maybe that's a lot of volatility on a New York Stock Exchange stock as opposed to over the counter or an Amex stock in the US or a venture exchange stock in Canada. But still, it's not a very interesting story. The fun starts in 2021. So it's back to where it was, and the craziness starts. And in late January, the stock hits a high of, I have on my notes here, a high of $347. So goes from 3 to 4 in early 2020, and a year later it's at $347. But I think that's even If I scroll down, I think that's understated because I think its 52-week high is more like $483, which I'm going to assume is an intraday, not a closing price that was printed, but an intraday. At some point during the day, it got up really high. So anyways, it goes up into the high 300s, 400, even $400, like in the 3 weeks. In the 3 weeks of trading in January, a crazy jump. People got wealthy, really wealthy. How did that happen? That's kind of the backdrop. Let's talk about the implications, starting with the short position. So as I said, until 2020 in the fall, the trading was around $3 to $4 because it's been driven down from this higher number. January 22, 2021, so right after that December 31, approximately 140% of GameStop's public float, which is the portion of shares of corporation, a portion of the shares of the corporation that are in the public markets, so that's available for you to buy. 140% of them have been sold short, meaning that some of the shorts had been relent and shorted again. Let's talk about what that means exactly. Let's understand a short. And to do that, let's first understand a long, which is sort of the opposite of a short. So a long, this is you buying a stock. You go out and you buy stock for $10 because you think it's worth more than $10. It's really that simple. You hang on to your stock for $10. Let's say that the market goes up to $12. You sell it. You bought it at 10. You sell it at 12. You made a profit of $2. That's a $2 on $10 is a 20% gain. And you take that 20% gain times all the shares that you bought, as much as you could afford. So for example, if you happen to buy 100,000 shares at $10, that would have been a $1 million investment. Most of you are not doing that, obviously, but if you did $1 million investment, say as a hedge fund or whatever kind of fund investor you are, and you get a 20% gain, well, that's $200,000 of profit on your $1 million. What happens conversely if the stock drops from $10 to $8? Then you lost $2. You lost 20%. You lost, if you had 100,000 shares, you lost $200,000. You sold your stock because you were worried about it dropping further, and you crystallized your loss of the $200,000. Now, if you think about this, your loss when you're in a long position, when you own stock, is limited to the stock going to zero. You went from 10 to 8, you lost 20%, right? If it goes to 0, you lost 100%. You invested $1 million, now it's gone. The stock's not worth anything, okay? Your gain goes from 10 to 12, you gained 20%. It could theoretically go to infinity. I've never seen a stock go to infinity, but it could go really, really high. And you have no limit to your upside when you're in a long position. That makes sense? So you got no limit to your upside, but your downside, your risk is limited to 100% of the money that you invested. That's what you do when you buy stocks. That's called a long position. I'm long that stock. It means I own it. Your short a stock is kind of the opposite. In a short, it is, what if you think you're looking at this hypothetical $10 stock and you're thinking, actually, I don't think that's going up. I think it's going down. How can I make money on that? Well, the stock's at $10. I don't want to buy it. I want to sell it, but I don't own it. So how can I sell it? You can do that. That's called shorting. How it works is you say to somebody else over here, and you do it through your broker. There's no actual communication. There's not even really a choice on the other side of this, but you borrow. What you do is you borrow somebody else's stock. So I go to Joe and I borrow his 100,000 shares, and I have to pay him some interest for that, but I borrow his 100,000 shares. Now I take these shares and I sell them into the market. So I didn't sell my own shares. I sold somebody else's shares because I borrowed them to sell them. Okay. So if I sell those shares, 100,000 shares, let's say, at the $10 of the market, I've now put $1 million, right? 100,000 shares times $10. I put $1 million into my brokerage account. And I'd probably leave it there because I've got capital requirements, but I put this money into my brokerage account, and it sits there, and I didn't pay anything to buy because I bought nothing. All I did was pay some interest to borrow some stock. I sold them. I put $1 million into my account. Now the stock drops to $8 like it did in our long scenario. In our long, we lost money. Now at $8, I say to myself, okay, that's enough of this trade. I owe Joe over here 100,000 shares. I don't owe him $1 million. I owe him 100,000 shares. And a lot of what you're hearing on social media and pundits, so-called pundits on this, right, they're getting this wrong. You don't owe the $1 million. You owe the 100,000 shares, regardless of what the price is. Really important to the story. All right, so what do? Well, I want to cover my trade. I want to cover my short position. So I go out and I buy in the market the 100,000 shares now at $8, which costs me $800,000 out of my million, right? I take my 100,000 shares and I give it back to Joe. I've repaid my debt, and there's some interest in there, but let's not get hung up on that detail. And so I have a profit. I brought in $1 million on my initial sale, and I spent $800,000 on my purchase to cover my short, to repay my share loan. I have $200,000 left over. I made the same money as I did on the long with that example, except on the long, when the stock dropped, I lost money. And on the short, when the stock dropped the same amount, I made money, same amount of money, by the way. Was that a 20% gain in the short? Well, no, because there was no cost. Like, I literally didn't spend any money to make that trade. It's a zero cost base apart from the interest. And I made $200,000. So it's, percentage wise, way better than the 20% on the long, which is a detail, but just to think about the math of this. Now, what happens on the flip side? I sell the shares. I borrow the 100,000 shares from Joe. I sell them for $10. I bring in my $1 million into my account, and I wait for the stock to go down, except it doesn't. It goes up to $12. Now I'm freaking out. My broker's calling me, and my broker, she's saying, hey, you need to up your margin. You need to give us more cash to make sure that we're not out of money on this. This is your problem. And I decide I'm getting out of this trade. So what do? I buy my 100,000 shares in the market at $12, which cost me $1.2 million. Okay, I had $1 million in my account already, so I had to put in another $200,000, and therefore I've lost $200,000 just to deliver my 100,000 shares back to Joe. So I have the same $200,000 profit. I have the same $200,000 loss, but in a short, I have them for the reverse reason as I would have them in a long. But if you remember in the short, we talked about risk. We said, well, you can only lose 100% of your money, and your gain can be infinite. Obviously, stocks don't go to infinity, but there is no limit on the gain that you can have. Whereas the short is also the opposite, because my profit is limited to having to zero, not to zero, sorry, to the stock going from 10 to 0. So I sell the shares first for $1 million, and then how cheap can they go to buy me back? To buy them back is the stock could go to 0, in which case I made $1 million theoretically. That's my upside. Like, that's a limit on my upside, but there is no limit on my downside, because theoretically the stock can go to infinity, and I'm going to try and buy back 100,000 shares at an infinity price per share. There is no limit to my losses on a short trade, which is why people think or express this as being an exceptionally risky way to go. I want you to keep that risky way to go thing in mind, because it's really, really, really relevant to the GameStop story. So let's go back. 140% of all GameStop stock was short in January, whatever the date was. I said at the beginning of this, January 22, 2021. What does that mean? Well, it means that 100%, all of the shares of this company that are in the marketplace were borrowed and then sold into the market. 100% were borrowed from somebody else and then sold into the market. And then the person that bought those borrowed shares took them, lent them again, and they were sold into the market by somebody else. So that 140% of the entire shares of the company were shorted into the market. And don't forget that 140% are shorted in the market. All of those loans, every one of those shorts has a loan attached to it, and it needs to be covered at some time, which means they have to be bought back. So that brings us to our next lesson in markets. You need to, if you're going to understand this story, you need to understand that in financial markets and stock prices, we talk about an efficient market. There's no such thing. We talk about, by the way, that's my opinion, not financial theory. There's no such thing. We talk about the value of a company, right? We talk about the markets reflecting the value of the company. I ask you, GameStop was trading at $3 within a year, and in that same year was trading at $480 odd, 483. I just found that number, $483 in the same year. Which one was the value? Which one was the value of this company? Clearly, market's not reflecting value. Okay, so the lesson here you need to understand is that markets are 100% supply and demand. Stock prices go up because more people want to buy them than want to sell them, or more dollars specifically want to buy them than want to sell them. Stock prices go down because more dollars want to sell them than there are dollars to buy them. It is that simple. Like any other market, it is supply and demand. If the bids exceed the asks, if the buys exceed the sell, stock's going to go up, and vice versa. So 140% of the entire market, of the entire shares of GameStop in a short position, that is a lot of stock to be sold. And if the selling exceeds the buying, it drives the pricing down. Piling on short positions is a self-fulfilling exercise. If you're a billionaire hedge fund guy and you talk to your friend, the billionaire hedge fund girl, does it make more sense for you guys? Does it make more sense for you two to fight each other? Or is it more sense to have a drink and say, I don't like GameStop. I think that's overvalued. Yeah, me too. And then go back to your separate corners and both start shorting this thing, because it becomes self-fulfilling. If everybody's shorting, the sales outpace the purchases, which drives the price down, which makes your short profitable, right? Getting on CNBC as a billionaire and talking crap on the company and screaming and yelling about how it's an old business model and COVID's going to kill it and nothing's going to come back is a self-fulfilling exercise. If you're short before you go on CNBC and scare off all the potential buyers, that's pretty self-fulfilling. You've created less demand for the stock, therefore the price is going to go down. If you happen to have a friendly research company which pretends to or appears to be super credible and independent, and you've got them on the side and they start issuing research reports saying, this company's crap, it's toast, right? We call these short reports. And this company's crap, it's a fancy report, and then they send it around to all of the fund purchasers, like the fund managers who might be long or may not own it, and they release it to the public, and then the researchers will get on CNBC and say, oh, this company's terrible. That's self-fulfilling, okay? It either causes people to sell or stops them from buying, which drives the price down, okay? That's how short selling is supported. Piling on short reports, research that are negative, getting on media saying negative things. That's what happens. By the way, if you own some stock, if you went long, are you going to tell your friends the company's crap? Or are you going to go to a cocktail party and say, I just bought this company XYZ, I really like it? That's the same thing. You don't have as much power. You don't have as much distribution. I'll tell you, I bought MMED, whose name I forget, Mind Medicine, something like that, a psilocybin company, probably 9 months ago when it went public. I made a decent amount of money on that, and I was on Martinis with Scott talking about why I like this company. Okay, how is that different from a billionaire screaming and yelling about how the company's crap on CNBC? I don't think it's that different. I don't have the power. You don't have the power. They have more power than us. That's life, right? But I don't think in principle them screaming and yelling about the short side of the stock is a big deal. So all these hedge funds, they're short. 140% of the stock is short. They're talking crap on the company, but remember, it's a bet and there's risk. And if something happens to start more buying pressure, if the buying side starts outweighing the selling side, what's going to happen? The price is going to go up. And when the price is going to go up, the shorts are going to move into a negative position, as we described, and that negative position is unlimited. Okay, so for example, if a bunch of people on social media decide to get together, which is exactly what happened on GameStop, and they're going to buy the stock, and there's sufficient in quantity to outweigh the supply and demand pressures, where the sell side is crushing the demand side, and all of a sudden all these individual investors start creating a bunch of demand and the price starts going out, and you're squeezing. It's called a short squeeze. Okay, so the price is going up, and every day the price goes up, or every minute the price goes up, the short seller's losing more money, and there's no end in sight because you don't ever get to zero on that. So what do the shorts have to do? Well, they have to cover. What does cover mean? Is they need to buy some stock quick to pay back Joe, who they borrowed the stock from. When they buy back the stock, what happens? That's more demand for the stock. So all of a sudden, what used to be a sell becomes a buy, and now everybody's buying and scrambling to cover their short position, and you have this exponential, explosive effect to share price. And what happens when you have an exponential, explosive share price bump is you get some other hedge fund guys and gals sitting around saying, wow, that stock's really gone up a lot. I don't think that's representative of the value of this company. I'm going to short it. And then they do, and they short it. And you know what happens? 3 days from now, the stock keeps going up because they missed entirely this whole global movement of the ordinary people buying this stock. And then what do those short sellers have to do? They have to cover their position as well. And when they do, it creates more buy. And when you have more buy, more than sell, the stock keeps going up. That is the vicious cycle of a short squeeze. It does not happen very often. Why doesn't it happen very often? Because the hedge funds have more money than you. That's why. They can just keep doubling down with brute force, but not this time. Not yet. Okay. In summary, in January 2021, the stock got to $483 from $3 the year before. Okay. So that's how the short side of this works. That's how the stock got so high, and it's how the hedge funds got in such big trouble. So now let's look at the players involved in this, and we'll start with the short side, the big bad hedge funds. Are they really big bad hedge funds? Look, I took some articles here from a website called zerohedge.com, which is an aggregator, I believe, of Wall Street related stuff. You can go to the site, check out some really great content, zerohedge.com. I'm giving them credit for this because I stole their content because it was easy for me and I thought it was relevant. February 3, this article is from. By the way, I think they took the content from somebody else as well, but let's give credit where credit is due. Last week, a number of small-time investors drove up the price of GameStop stock to a historic 1,784%. But it was no mere spike in an obscure stock. The stock's price spiked in part as a result of efforts by an army of smaller investors who have been rallying on Reddit, which is a social media news site that you can, like a chat board, and elsewhere online to support GameStop's stock and beat back the professionals. The professionals were hedge fund managers who had shorted GameStop's stock. In other words, hedge funders were betting billions that GameStop's stock would go down. But the price went up instead, meaning hedge funds like Melvin Capital and Citron Research took a significant loss, possibly totaling $70 billion. $70 billion. It appears that for many smaller investors who were involved, much of this short squeeze, we talked about what that is, was conducted for the purposes of throwing a monkey wrench into the plans of the Wall Street hedge funds, which exist within the rarefied world of billionaires and their friends. Remember, I talked at the beginning of this about this overarching narrative of populism and the ordinary man against the elite. And I just think it's a huge part of this story. And the buyers on this, the Reddit people, that was their narrative, right? They're getting back at the Wall Street. They're getting back at the elite. We're going to talk about whether that's real or not soon, after we talk about the short side. Commentators were telling in that this was clearly fear and outrage over the fact that business as usual on Wall Street wasn't being enforced. Predictably, much of the reaction to the Reddit rebellion was to label it a fiasco, insanity, and something sure to leave a trail of destruction. Jim Lebenthal at CNBC, for example, declared the short squeeze fiasco is a threat to the proper functioning of financial markets, which is bullshit. The fear-mongering went beyond even the usual places. On The View, for example, Meghan McCain delivered sort of the same message. I'm paraphrasing. I'm not reading his article. It's in better English than what I'm giving you, although not much. She insisted the GameStop affair could spiral into an economy-killing disaster. Again, bullshit. Because if the stocks end up plunging because of this, Wall Street loses billions, and at a certain point it will impact stocks like Apple and Disney. No, it won't. And stocks that a lot of average Americans do invest in, and average Americans will end up losing money. Well, that part's true. We're going to talk about why. Her comment doesn't really make any sense. She doesn't seem to have even a rudimentary understanding of what happened. Well, I'm sure that's true. And she compared the Reddit people to the Capitol Hill insurrectionists. So there's your elite fighting back at the ordinary people, comparing them. And if you don't believe that, I think there's that this whole story exists because of the overarching narrative of populism. Well, there's your evidence right there. So billions of dollars being lost by the hedge funds, framed as a battle as the little guy versus the big guy. Are the hedge funds the big bag hedge funds? Should we worry about them? First of all, should we worry about them losing billions of dollars? Hell no. Hell no. Good on them, right? And I don't hold any grudge against the hedge fund people, the guys and gals that are making billions of dollars and making these huge bets, but they take huge risks to make huge profits. If they never lose, where's the risk, right? Why would we have a problem? I don't think we should stop people from taking huge risks, but why do we have a problem with them taking a loss? Why do we have a problem with the small guy fighting back? I don't have an issue with that, because if we have an issue with that, where's the moral hazard? Where's the moral hazard for shorting 140% of a company's stock? Some of these hedge funds need to go bankrupt, right? Then maybe the next hedge fund will say, perhaps we should short this, but limit the amount of our short so that we don't go bankrupt. And we actually do some hedging. Hedging means protecting your risk. Hedging technically doesn't mean betting all of your capital on some one crazy trade. It means protecting your risk. Finding a hedge is the language for it. And if you're losing all those billions of dollars, 70 billion, what did I say, 78 billion? That's not being hedged, that's being exposed. And you need to have, as a financial system, there has to be moral hazard. Otherwise, the financial system just turns nuts, which, by the way, is where we're at, right? Where was the moral hazard in 2008 when the whole financial system fell apart and Lehman Brothers became, and what were the other Bear Stearns? They became the sacrificial lambs, and everybody else was bailed out. Was that a good system? Where was the moral hazard in the derivatives trading that ultimately caused that? You know, these companies have to be able to go bankrupt. They just have to. Otherwise, there's no system that's ever going to work in the long run. Don't feel bad for the hedge funds. You know, you print trillions of dollars. You know, since 2008, we've been printing in the U.S. trillions and trillions and trillions of free money. Maybe not trillions and trillions. Billions and billions adding up to a trillion or more of free money. A few trillion. Let's just stick with that number, Scott. Free money. And who are we giving it to? Is it going to the house painter? Is it going to the house painter in Columbus, Ohio? Or is it going to the Wall Street hedge fund billionaire people on Wall Street who are taking that free money and betting it short against GameStop? I think we know the answer to that. The hell with them. I got no problem with them losing billions. But are they evil? Are they evil for this business, as is the narrative from the populist side of this political, philosophical, societal debate? Are they evil? You know, why does shorting even exist? Well, there's this lame argument, lame in my opinion, that it adds to liquidity in the markets. I'm not sure that that really adds much of anything. But I will tell you this. I'm not an investor and I'm not a trader, so I'm talking to you peripherally from the outside, semi-inside on this, but I can't think of a major securities fraud in the last 15 years, maybe even longer. I can't think of a major fraud that was discovered by a regulator. There's been a couple of whistleblowers, but for the most part, every fraud was discovered by a short seller. Why? Because they're motivated to find companies that are weak, that potentially are just making stuff up, shorting that stock and getting on CNBC and yelling about it, calling the regulator, doing a bunch of research, doing a bunch of detective work, sending it off to the SEC, sending it off to the OSC, getting on the regulators and saying, this is a fraud. Do you remember No Forest, the Chinese company that was in the forest business and turned out didn't have very much forest at all? A bunch of other Chinese stocks during that wave were all alleged and turned out to be probably frauds. We covered on Martinis with Scott and Freya, which nothing ever really happened to them other than a change of management and tightening of internal controls. But all of that front-running stuff, you can go back on the Martinis with Scott channel and look at that cannabis stock in Canada. All of that was driven by short selling. Okay, they are motivated as short sellers to find these problems and then to profit from them. Is that a service to the market? Well, I don't see how those frauds are going to be discovered otherwise. So I think there's a definite service to the market. Now, if a short seller has 10 ideas during the year, what percentage of those are actual frauds and what percentage of those are not frauds that the short seller is just making up to be a fraud and is just killing the company? I don't know the answer to that. I don't know if it's 50-50. I don't know if it's they found 1 out of 10 was an actual fraud and the other 9 they're just doing damage to the market. That's possible. I don't know. I don't know the answer to that. But and can they destroy companies? For sure, right? You take a company like GameStop and you drive its stock down to $2-3. It's unable to raise more capital. You start triggering covenants with your financial lenders. You can get into all sorts of trouble on that. But I will tell you this, if you didn't have this service in the market, if you didn't have the shorts in the market, a lot of fraud is going to happen and you're never going to find it. So are they big and evil? I don't know. Probably it should be better regulated. I don't see the point in 140% short position. I sure as hell don't see the point in that without some moral hazard to go along with it. But I think there's a role for shorting in the market. You're looking for some of my hot takes. There's one of my hot takes. Let's talk about the long side. Let's talk about the little people. On Reddit, which is a social news website that I've never been onto, there's a subboard called Wall Street Bets. It's an online community known for discussion around high-risk stock transactions. Observers congregating around Wall Street Bets believe that the company was being significantly undervalued, and with such a large amount of shares being short, they could trigger a short squeeze. We talked about that. By driving up the price to the point where short sellers had to capitulate and cover their positions at large losses. We talked about that. Even before the short squeeze, there had been interest in GameStop. Keith Gill, known by the Reddit username Deep Fucking Value and the YouTube and Twitter alias Roaring Kitty, purchased around $53,000 in call options on GameStop stock in 2019. So let's stop there for a second. Remember I said in the fall of 2019, it sort of went up to the end of, it started rising. It started rising and then continued. So he took the position 2019, and then I think he doubled down into 2020. And so the stock started rising. He took a significant position in GameStop long before this ever happened. And I want you to continue to think about that or remember that when we get to the end of this discussion on the long side of this issue. And another thing I want to mention to you is, so you can go long by buying call options, which is what this deep fucking value person did. And you can go short by buying put options, which I think a lot of the hedge funds did as well. And I chose not to cover that because it's not as simple. But let's talk about this call option, this $53,000 that this fellow spent on call options. What does that mean? Well, a call option is a contract. It's a right to buy shares in the future. So let's go back to our hypothetical $10 stock. If I buy a call option, I have the right to buy from you sometime in the future. Let's call it 3 months from now or 6 months from now. I have the right to buy from you that stock at $10 a share. Okay? And you are forced to sell me that stock at $10 a share. So if that stock goes to $12 at the end of the contract, let's call it 3 months from now, then I've got a market of $12. I got a contract to buy at $10. I could buy the shares at 10. I can immediately sell at 12, and I made my $2 profit. Okay, so there's my gain on of $2 per share on my call option. By doing that, the call option, the pricing of that contract is pretty cheap in comparison to the price of the shares. I'm not paying anywhere near $10 a share just to buy that right. I'm paying pennies a share for that right. So I can, with a little bit of money, have the right to buy a whole lot of shares 3 months from now if the market is in my favor. 53,000. I don't know what the price of his contracts were because I didn't go back to look, but $53,000 gave him the right to buy a lot of shares. 3 months, 6 months, 9 months, however long that contract was. What happens if I have the right, a contract to buy your shares at $10 and the market at the end of my contract is $8? Am I going to buy your shares for $10 to sell them at $8? I am not, because that would mean I'll be forcing another loss of $2 a share. What happens if the stock is $9.95? If it's gone down 25 cents, am I going to buy your stock at $10 and sell it for $9.95 in the market? No, I'm just going to let my option expire. I'm never going to call on your stock, right? So what happens if the stock is $10? Is it unchanged? Am I going to call on your stock? No, why would I bother, right? Then I'm just trading dollars. So here's the thing about the option, about the call option. You got to assume that you start by saying to yourself, okay, I just lost $53,000. And the only way to get it back is for the stock to go up. And it has to go up enough that the margin I make on the $10 purchase price minus whatever I sell it for is enough to pay the price that I paid for the options contracts to begin with, right? But the only way to make money is for it to go up. And if it doesn't go up, it is 100% guaranteed you have lost $53,000. Let me ask you a question. Are you an ordinary person? If you're an ordinary person, do you have $53,000 to buy a call option that you know for a fact, if the stock does not go up, you've just lost $53,000? Can you afford $53,000 on a call option? I can. I'm not an ordinary person. I have some money. Okay, I can afford that $53,000, but even me, what do I want to know before I spend $53,000 on a call option? I want to know goddamn well. Sorry, I know you probably don't like when I use that Lord's name in vain. I want to know absolutely that stock is going up. How might I know absolutely that stock is going up? Maybe because I'm influencing a message board with a bunch of people on it that buy stock, and I can create a narrative to get them to buy stock. Possible, right? That might be a good way for me to be sure that my stock is going to go up, that I just dropped $53,000 on, that I'm going to lose if the stock doesn't go up. Something to think about. This guy spent $53,000 on his call options, which his position rose in value. And in January 27, 2021, his position was worth $48 million. He spent $53,000, went up to $48 million. I doubt the math on that is exactly right, but you get the point. All right, Gil, a 34-year-old marketing professional and a CFA, stated that he began investing in 2019, believing the stock undervalued. He was chatting with Deep Fucking Value on Reddit, provide regular updates. He just stated on January 29th, after the short squeeze, that he thought this trade would be successful, but never expected what had happened over the last week. Planned to continue his YouTube channel as Roaring Kitty and potentially buy a house. I bet he will. Good on him. January 27, technology news website Mashable reported that the subreddit had broken page view records due to the short squeeze. So this is the website, the social media website where people are communicating. It received 73 million page views in 24 hours. Fastest growing subreddit on the board. Community surged by more than 1.5 million users overnight to a total of 6 million users on January 29. So I said that this story wouldn't exist if you didn't have the overarching theme of populism, the ordinary man versus the elite. It also wouldn't exist if you didn't have the power of social media today. The board went viral. It went viral, not necessarily beforehand, but during, which added to the buying spree for sure. So, okay, so these are the narrative here is that these are the little people, and we now understand how the stock went up so much. So I have two questions that I think we should debate. Is there value? Is there value in GameStop at $483 a share? Or $400 a share? Or $350 a share? Or is it $483 a share or whatever number simply because of supply and demand? The buyers are exceeding the seller and the price keeps going up because there's always another buyer. There's always another buyer. There's always another buyer. Is that not the very definition of a Ponzi scheme? Is that not a pyramid scheme, a Ponzi scheme? The very definition of that? It is, right? And therefore, 100% for sure, this is going to crash. As soon as the people get bored with this story, they move on to the next story. What's going to happen? I 100% guarantee you this stock is going back to $15 and then to $3 when this all sorts out. 100% guaranteed. In fact, as I was writing this about an hour ago, the stock, I looked at today's trading, the stock had dropped to $92. By the way, I shoot the show on, as often as I can on Wednesday to release on Thursday. So this is Wednesday information. The stock has already dropped down to $92. I promise you it's going back down to where it was. Who gets hurt? Who gets hurt by that? I'll tell you who gets hurt. It's my mother. It's your mother. It's people who heard about this and thought, oh, I got to get on this bandwagon. I'm going to buy in at $300 or $400 a share. This is a Ponzi scheme. That's what this is. You want to know why the regulators are looking at this? Do you think it's because the Wall Street controls the regulators and they're going after the little people? No. It's because if there was market manipulation, if there was a bunch of people getting together on a message board, driving this thing up, then people are going to get hurt. And the regulators ought to take a look at that, which leads me to question number two. Number one was, is there value there at $400 a share? Obviously not. Question number two, are these little guys white knights? Are they the good guys in this story? We already know the narrative on some part of this is to accuse the hedge funds of being bad guys. And on CNBC, their narrative is to accuse, and for McCain, is to accuse the little guys of being the bad guys. But are the little guys or the ordinary people the white knight on that? On this one, let's talk about what stock promotion is. Old-fashioned, old-school stock promotion. Around 2001, I was trying to raise money for a public company on Bay Street in Canada. And I had about a 5-cent market. In fact, I think we were trading at 3 cents, but the minimum that you can raise money at with the regulation at the time, maybe still in Canada, was 5 cents. And I was trying to raise money on a decent business plan, and I needed $6 or $7 million, somewhere in that range. And I wanted to raise it at 81 cents into a 3-cent market. 81 cents into a 3-cent market. And this was right after the tech bubble had burst. Nobody had any money. Everybody was skittish. And it was, needless to say, a tough deal. by the way, the end of that story is I raised about $8 million at 81 cents. I did it myself. I put on about 30 pounds eating and drinking up and down Bay Street for 9 months or whatever, however long it took. But I got it done. But before I put on all that weight, I went to the top brokerage firms in the country. I'm not going to drop any names, but I went to all the top players in the country, and I heard the same story and over again. As with Scott, no problem. We'll raise you $6 million. We'll do it at 81 cents a share. Here's what I need from you, Scott, apart from a little work fee of whatever, $100,000, is I need you to deposit 3 million free trading shares into my brokerage account offshore in the Bahamas, and then I'll raise the money for you at 81 cents. So you deposit the shares for free, not 3 cents, for free into my brokerage account, and then I'll go raise you the money. So I'm not a securities expert. I don't advise on securities. I don't know the legalities of that. Doesn't pass the smell test to me. I'm going to assume it's illegal. But back in the day, that's what the message was, and that's why I chose to avoid it. Now, why? Why might someone suggest to me, if someone was the head of an investment banking group, why might they suggest to me that that's a good idea? Is it because they have a bunch of retail brokers at the other side of the floor who manage your RSP account, your IRA account, who have a little bit of your money and can call you up as a stockbroker and say, hey, you should buy this stock. You should buy this stock because it's going to the moon, right? And when you buy that stock, it drives the price up, so they're raising money. But who do you think might be selling that stock into the market that is now being promoted by the retail brokerage of that exact same firm and all the other retail brokers, because they're all buddies? Who do you think is selling that stock? Is it the guy with 3 million free trading shares that he got for free, selling it for 81 cents, putting $2.5 million of free cash, tax-free, into his illegal probably, account in the Bahamas? That's what a stock promotion is, okay? It's standing behind the retail broker, yelling at them, getting them to get their clients, you, to buy the stock while they're trading into that stock. They're selling, they're creating demand so that they can sell. And this is not the clean, legal stock investor relations and the related, what's the word that I'm looking for? Anyways, whatever. Putting out press releases, doing roadshows. There's none of that clean stuff, okay? This is illegal, dirty stuff that you should have nothing to do with. I should have nothing to do with, and I haven't. But that's the way it worked. What would the modern version of that be? Would it be, in a modern world, would it be a social chat line? Would it be a bunch of people online colluding to drive up the value of a stock? And maybe if there was an overriding, compelling, huge narrative going on in the world of the little guy, of populism, of the little guy versus the elite, might someone who is smart and conniving think to themselves, I could use that overriding, that overarching narrative, I could use that to rile up the people to fight the hedge funds, and maybe I could buy myself a $58,000 call option and get things going on this board and make myself $42 million. Not suggesting anybody did that. I'm not suggesting anybody did that. But if they didn't do that, why do you think the next person won't? I think it's 100% guaranteed. It is 100% guaranteed that this is not limited to one stock. In fact, there was a bunch of other stocks that started going up, pushed by this Reddit group. And it's 100% clear that there were significant positions taking at the cheap price before this became a group chat. Okay, someone is manipulating these people, and if they didn't on this, they're going to do it on the next one. I promise you that. Just like I promised you, GameStop's going to drop back down to 15 and then probably to 3 because the shorts will jump on again. They won't learn from this. They're going to do it all over again. Okay, just like I promised you that, someone's going to start promoting the next stop. They're going to have a huge position first. They're going to get it up in a promote, which is like a Ponzi scheme. They're going to exit during that. And then they're going to move on to the next one, and the whole thing's going to collapse, and the ordinary people are the ones that are going to suffer. That's what a stock promote is. Are these the lily white people? Hell no, they're not. And you, when you're thinking about this story, you should possibly reject the idea that anyone who has touched this, you should reject the idea that they're involved in an altruistic way with good motives. I don't believe it. I think they all deserve each other. That's my personal, you want my hot take? They all deserve each other on that. By the way, I haven't, running out of time, 55 minutes. I was going to touch on the trading platform, Robinhood. I'm just going to say quickly that when they've been accused because they put a halt on the stock and did the unusual thing of saying you can't buy the GameStop, but you can sell it. Well, and then they're accused in the narrative of siding with Wall Street, siding with the hedge funds. That's all crap. That's just all crap. There's none of that going on. That's zero upside for them and all sorts of downside for them. What's going on there, and a bunch of other trading platforms that stop, is that there's a clearinghouse, and the clearinghouse in this case was Depository Trust and Clearing Corporation, and for equities and options, and they require collateral because there's 2 days between, okay, we put in the order, and then there's a couple of days until that trade clears, and the platform, the brokerage house, needs to put up cash as security to the clearinghouse to guarantee that trade. And if the stock goes from $3 to $400, well, then the amount of collateral goes up a lot, and they just couldn't afford it. And how could they? How could anybody afford that? So they literally couldn't afford to do more trades. Does that mean that you as an investor can't buy the stock? No, you could go to a different platform where they didn't put a halt on it. So it's just stupid to say that they put a stop to this inclusion. You could have went to somebody else's platform and bought the same stock and kept up your little pyramid scheme, your Ponzi scheme. So they just ran out of money. They've raised, on January 29th, they raised $1 billion to shore up the financial pressure. Just so it's not a profit loss. They're probably making a fortune on trading fees during this. It's putting up the collateral to the clearinghouse. And I understand after that they raised a few more billion or whatever they did. So they raised a bunch of money. That's why they did that. They're not the bad guys in this. Maybe there's other reasons there's bad guys. Probably is, right? It's a dirty industry, but not from that. Thank you for listening. This has been Martinis with Scott. Even though I'm having a scotch, I hope you're having a great Thursday evening. I hope you enjoyed this story. Alina, there's my hot take. Thanks for listening. Please subscribe on YouTube.